Hello and welcome to this week's market dashboard. This is July 19th, 2025, and we'll review rapidly what happened this week. Actually, not much, happened this week besides the noise. If we took a look at what the asset classes did, less than 1% move, only more than 1% move for oil, but considering the volatility of oil, that's not significant anyway. What happened this week? We had rumors about Powell being fired, and then denial by Trump that Powell will be removed before his term. We had a couple of economic indicators where the usual dance between good news is bad news is good news, that kind of stuff, but overall not much. Maybe the only significant move for the week was Bitcoin. That didn't last. We went close to, we made a new all-time high, I believe, close to 124K for Bitcoin. Now today we are back to $117,000 for one Bitcoin. So overall, things are moving below the surface, but overall for the week, not much. And we can see this, the S&P here, which is shown with the VIX. You can see that the S&P is around its all-time highs, and the VIX is being crushed to quite lows. So it seems that nothing much is happening at this time, very quiet. But if we look in details, so we have the S&P and the Qs back into significant positive territory, being respectively up 7.7% and 10.1% year to date, when the Dow Jones Industrial Average is only up 5% and the small caps are only up 1.1% for the year. We're going back where we started the year, basically with some over concentration into the tech sector, where the smaller caps are lagging behind significantly. The smaller caps are the ones that are more trapped into these tariffs, when most of the bigger companies, tech companies, are global and can find turnarounds. And it also seems that at this time tech sector behaves more like, in terms of equities, as surprisingly the safer sector, if you like. So we see that long-term bonds are doing nothing for the year. We have midterm bonds slightly up, and the biggest winner beside Bitcoin for the year is still gold. So now, if we look at the sectors again, we still see so that's the relative performance of some indices versus the S&P 500. And since the recovery, the tech sector has taken the lead again, is overperforming the S&P 500, when the Dow Jones Industrial Average is underperforming, and the small caps remain stuck at the bottom. If we look at some, I don't have it here, but if we look at some statistics that were published by one big bank, I don't remember which one, it shows that levels of concentrations into the tech sector are back at historical levels, much even bigger than what it was at the top of the tech bubble in the 2000s. Because if we look at each sector versus the S&P 500, we see that the only one sector pulling the global market, I would say, is the tech sector. All the other ones are underperforming the global index, such as if you look at financials, utilities, obviously, defensive sectors since the recovery, consumer staples. You have energy, healthcare, but the only one that is going up versus the S&P 500 is the tech sector. So that's at this time the only one pulling the market up. Now, if we look at foreign equity indices versus the S&P 500, you know that, so there was a statistic saying that capital flowing out of the US market from foreign investors, and it's at some of the very significant low historically. But there's a couple of reasons for that. Despite that, the performance itself of each indices versus the S&P 500 is lower. Why? Because you have to realize that, so for foreign companies, foreign investors in their local currency, considering the weakness of the US dollar, what happens is that when the US market is making new highs in US dollar, in euro for instance, considering the strength of the euro and the weakness of the US dollar versus the euro, the S&P 500 in euros has not made new highs, which is one reason that makes the US market slightly less attractive compared to their own local domestic market. Specifically, if we talk about euro, where we see here the euro stocks, French equities and German equities, the strength of the euros, the euro is going up for all the wrong reason, I would say at this time. Because the Europe has difficult situation in terms of deficit, in terms of government deficit, in terms of debt, as the US, but the euro is not the reserve currency of the world, and that's the strength of the US dollar, and that's why the US can afford to do things with its monetary policy that Europe cannot do. So it's a kind of a weird situation to have euro overperforming the US dollar at this point, considering the difficult situation that Europe is in at the moment. So why do I show you this? For a simple reason. This is TLT long-term US bonds. They are under pressure again. You know that Dalio and Diamond said that there would be a bond crisis at some point, specifically if rates are still going up. So we may have another round of inflation coming from tariffs, or for many other reasons that is detailed in the newsletter, by the way, where you can find the link below on LinkedIn. And the thing is that we are at the point where the administration kind of panicked in April, where they had to intervene and pause the tariffs. Now we come at a point where a large set of tariffs are expected to be implemented very soon on August 1st against many countries. These are still being discussed. You can see Trump mentioning about different levels apply to countries about every day, depending on where the negotiations are going. So this will be again to monitor, because the credit market is the capstone of the global world financial structure, and if it collapses, this would be a major crisis for everyone, basically, and every asset class. Obviously the only asset classes that could benefit from this would be gold and potentially Bitcoin. We're not there yet, but this is something to keep in mind. And so we had quite some moves on the cryptocurrency. So Bitcoin again hitting new highs, going back down. So that's the reference that I had yesterday at 119. This morning is slightly lower, but not much. Again, about flat for this week. When the other cryptocurrencies recover quite significantly. Remember, I mentioned last week that when Bitcoin was making new highs, the other cryptos, the altcoins were not making new highs. So it's kind of a catch up at this time, specifically at the time where the crypto space is pushed basically by the current administration, passing bills that are in favor of this economic sector. Now there's another point that we can say about this, specifically about Ethereum, which had built a very significant short position in the cryptocurrencies. And what we had this week basically was a very classic short squeeze on Ethereum. If you look at the commitment of traders report, which shows you where the investors are, which side of the boat basically investors are, they were all on the same side on Ethereum, on the short side, and basically they got squeezed. Which, by the way, makes me think about the equity, U.S. equity market, the S&P 500. We have reports from Bank of America, I believe, that funds have the less proportion of cash at this time, and when less than 3.9%, I believe, which is a level where every time it hit that level, the market corrected at this point. So that's another of kind of warning, because everyone seems to be on the same side of the boat at this time. Now we see that market activity has collapsed for now, basically every sector. Even oil, that was the only one that was going up, is coming down as well. The level of activity on the S&P is collapsing further down, which makes me think again, it's a little bit too much calm. Forget about that. So you see the global activity indicator going down as well. Not surprising, since all these components is going down. Now I wanted to show you this, which is again the risk-adjusted momentum. So the momentum adjusted to risk, and risk being the volatility at this point. What you can see, again, that's an indicator of some of the funds or managers that are implementing a strategy similar to momentum and are risk adjusting the position. That gives you an idea of what their position would be, and specifically how this position change, which is even more important. So what you see here is that we have seen the S&P recovering since the bottom of April, both in terms of momentum and volatility collapsing. So this week, even if the momentum is not getting any stronger, the volatility, the risk is shrinking, which makes the risk-adjusted momentum bigger. What this means is that potentially some of these managers may increase their positions in US equities, or here represented by the S&P 500, which kind of confirms what I just said about the level of cash or the level of investment of some large funds, which are mostly invested in US equities anyway, which are at their level of cash, which are historical low levels at this time, and that might be a reason why. And we'll finish with the greed fear index. I will implement some modification of this, but about this, which will tilt this index, but not in significant way. But I would say that it would take this grid fee index slightly or more on the grid side at this point, but we are nowhere near extremes at this point. So like I said, for the whole market dashboard, everything looks quiet at this time, a little bit too much quiet, to be honest. And the market is always made of this: period of contractions, period of volatility contractions, and period of volatility expansion. Risk contraction, risk expansion, that's how it works. When it's too quiet, it doesn't stay long there, and when it's too crazy, it doesn't stay long there either. That's the way it works. You probably have this as well in your life, ups and downs, that comes and goes. We have a saying in French, probably something similar in English, where after the rain comes the sun, but after the sun comes the rain. So that's about it for this week. Thank you for being here as always. Enjoy your weekend and see you next week.